Hello everyone and welcome to Gentlemen of Action, your channel that covers finance, business, self-improvement, and other economic news that will always keep you in the action. My name is Armando Cuervo and I want to cover a couple of articles that are primarily focusing on the crypto and blockchain space. So let's get right into it. Barron's reports BlockFi to pay the largest SEC fine ever for a crypto case. I'm not sure if you know, but the SEC has a real big track record for suing everybody every other hour, so it's not at all surprising to me. But let's read on. Okay, crypto asset owners could earn an 8% yield by lending their holdings to firms like BlockFi Lending. The trouble is, trouble. According to allegations in a Monday order from the Securities and Exchange Commission, SEC, BlockFi's lending product was fraudulent and illegal. Yeah, they say that about everybody, but I digress. Let's continue. So, BlockFi agreed to pay a $100 million fine, the largest penalty ever assessed in a crypto enforcement action, to settle charges by the SEC in 32 states alleging that the Jersey City, New Jersey-based firm failed to register its BlockFi interest account lending product as a security and misrepresented the product's risk. Okay, a lot to take into that. Let's continue. In settling the case, BlockFi didn't admit to the regulator's allegations. It will halt U.S. sales of the product and introduce a new one that complies with the securities law. So, a few things. Number one, the first mistake that BlockFi did was having their headquarters in Jersey City, New Jersey. Last time I checked, that state does not allow you to pump your own gas and has very high taxes and horrible governors. But I digress. That's a different topic. Nothing good comes from New Jersey, including my ex. But on a serious note, what BlockFi did correctly, though, besides having a horrible headquarters, is that they didn't admit to the allegations. You never admit that you broke the law. I mean, any lawyer would tell you that. I'm not a lawyer, but I know that much. But it looks like that they just gave the money because they wanted to say, take your money, go. We call it the cost of doing business. I guess that there's always companies out there that know that they're going to have to pay a fine or they're going to be sued frivolously, and it's the cost of doing business. Or at least that's what they call it. But let's continue. In its own announcement, BlockFi said it would file an SEC registration statement for a new crypto lending product called BlockFi Yield. Okay, so they're going to do a new product, and they're going to move investments in its BlockFi interest account over to the new product, unless customers otherwise instruct the company. Very good. And it says here, international investors aren't affected by this enforcement action. Later on in the article, they do cover what's the makeup of those with this account, but I'll get there in a second. It says here, as said by BlockFi's chief executive, Zach Prince, labeled right here, from the day we started BlockFi, we have always known that the strong engagement with regulators would be critical to the adoption of financial services powered by cryptocurrencies. That's what they said in the company's statement. Today's milestone is yet another example of our pioneering efforts in securing regulatory clarity for the broader industry and our clients. And shows right here, other networks or other prominent crypto lending firms are Celsius, Coinbase, among others. Though it looks like that they did not immediately respond to any inquiries from the SEC action, which, why would they? They don't need to they don't need to be involved in that, honestly. They just need to see what happens and then follow suit. So it says here, the BlockFi interest account paid an interest rate to retail investors who lent their crypto assets, which BlockFi lent onward to institutional investors. That was what the original product was. It says here, the fraud allegations in the settled case said that BlockFi's website told retail customers that lending their crypto assets to BlockFi was secured. Yeah, that's fair. And because BlockFi, now they said that this was secure because BlockFi's loans to institutions were typically over-collateralized. That's the magic word, because they said typically, actually, they put this in quotations. So collateralized or over-collateralized. Collateralized means that you make a loan and there's collateral, meaning that there's something that's backing the loan in the event that you hopefully don't, you inevitably default. If you default on the loan, they would be able to take the collateral. Some people might do this where they might try to get a loan, would say that they use their car as collateral after they pay off their car. Or they may take out a loan that might use their home partially as collateral. It's just a way to say that the loans are backed by something, or in this case, they're backed by cryptocurrencies. Now, according to the SEC order, however, most institutions refused to provide BlockFi with the collateral it wanted for the loans. And some 70% of BlockFi's institutional loans weren't adequately collateralized. Okay, I can see that. Basically, was it an outright lie? Maybe. I'm not a lawyer. That's not my place to figure it out. But basically, to me, this is just another way of saying that BlockFi knew that it was giving out a product, and a lot of people liked it. But the problem was SEC saw their language, found one or two words that were off base, and then they went ahead and slapped them with a $100 million fine. Now, to me, $100 million is a whole lot of money. I'm pretty sure that most companies don't even make $100 million in a year. But I can see why BlockFi just went ahead and paid it, because they basically said that they would have to have active engagement with regulators. In other words, they knew that they were going to have to pay somebody off because everybody would be looking at them under a microscope. And it says right here also, just important, why they don't seem to care about paying $100 million. It says here, according to the SEC's order, BlockFi began offering its lending product in March of 2019, accumulating as much as $14 billion in crypto assets under the program from nearly 600,000 retail investors around the world. Some 400,000 of those were in the US. So I can see why they just went ahead and paid it, because more than half of those who were using the product were US citizens or US clients. So them playing nice with the SEC makes sense. This is just another way of saying cost of doing business. We just got to pay this. Let's continue on. Now, to me, I don't like the fact that the SEC is just a big baseball bat that's going to tell you to go and pay something. And you know who else agreed with this? The SEC's Hester Pierce, as it says right here, also reported by Barron's. SEC's Pierce says BlockFi deal not constructive for crypto lenders. I like this lady because she knows what's up. She says right here, Security and Exchange Commissioner Hester Pierce pushed back against the agency's $100 million settlement with BlockFi lending on Monday, telling Barron's the agreement was not constructive as a means of regulating the industry. I don't think it was constructive either, because it's basically saying, once again, there's a baseball bat to your face unless you pay me, right? Okay. Says right here, the deal hardly looks inviting to crypto lenders as a new regulatory template, according to Pierce. The SEC's lone Republican commissioner and longtime crypto proponent, which they just made this political, that's fine. But at least we know that she's pro-crypto, because it says it right there, but you can tell that she is pro-crypto. She voted against the settlement and issued a statement in dissent. They have a link to the statement. I don't think we really need to look at that, but let's continue on. We're taking an approach that's not constructive to figuring out how we can look at these new products and achieve investor protection goals while not precluding people from participating in products and services they're interested in, Pierce said in an interview. The SEC has loathed to try to accommodate the new technology in a way that meets investor protection mandate, but also allows things to move forward, she said. that's been a perennial problem at the SEC and is likely to be a problem in crypto lending as well. She's basically saying that the SEC seems to have a constant loathing of cryptocurrencies and blockchain technology. It's always been a problem. They're citing that basically the laws that they're using are the Securities Act of 1933 and Investment Company Act of 1940. At least as said by Gary Gensler, who's the chairman of the SEC. They're using laws that are over 80 years old that probably had no idea that we would ever get to this level of technology. Now, I agree, old laws can still be applicable to new technology, but Heather Pierce is basically saying that the SEC, they're not willing to accommodate, they're being very rigid, and they don't really care about the industry evolving to be better providers of product. Again, they're just a baseball bat telling you to pay up. And honestly, that's how all legislation, that's how all big government is anyway. But again, that's my opinion, whether you agree with it or not. The good and the bad of both these stories. The good, we're one step closer to having a more legitimate crypto industry and having the clarity that people are looking for, so then more money can flow into cryptos, which means it would make us all prosper. At least that's what the executive of BlockFi thinks, Zach Prince. Though the bad is, it's not exactly the best way to tell other platforms, hey, you can come on in and we won't sue you, because they're basically saying, hey, if you come in, we're going to sue you. And a lot of these new startups, if they were to get the same fine of $100 million, that could be 10, 20% of their seed money that they need to become the platform that we need. So the bad is, it's not going to be too good for anybody trying to enter the space, which then means less competition, which means that there's less competitive rates and less competition to be able to choose a product that is great for us. So those are the two parts, the good, the bad. Now, what's the really ugly part? They're in New Jersey. They should probably leave that. You can always come down to Florida. I mean, no state income tax. It's good stuff. Let's continue on. And in other crypto news, as reported by the Cointelegraph, Binance invests $200 million in Forbes to boost consumer knowledge on Bitcoin. Media is an essential element to build widespread consumer understanding and education, so said original Binance CEO and founder Changpeng Zhao. Okay, what are they saying? Binance, the world's largest cryptocurrency exchange by trading volumes, is making a strategic investment in the 104-year-old magazine Forbes to improve consumer understanding of cryptos and blockchain. Forbes and Magnus Opus Acquisitions, a publicly traded special purpose acquisition company, or SPAC, officially announced Thursday securing a $200 million strategic investment from Binance. Forbes previously announced plans to go public through a business combination with Magnus Opus in August 2021, and the deal was expected to close in Q1 of 2022. Now, this was the original article, by the way, by Forbes, says right here, August 26, 2021. Forbes to become public company through business combination with special purpose acquisition company Magnum Opus. Now, truth be told, I kind of did not know that Forbes was a non-publicly traded company. Publicly traded company means that you're on the exchanges like New York Stock Exchange or the NASDAQ. Not every company is publicly traded, meaning that you can't invest in every company in the same way that you can buy a share. For example, right now, at least as of the recording of this video, which is February 2022, you cannot buy shares of Forbes right now because it's not publicly traded yet. It's a private company, which means that the only way you can own a piece of Forbes is if you contact Forbes directly. Probably not now because they're making this agreement, but before you would have to call Forbes directly and then say that you like to have an equity stake, meaning, let's say, buy 10% of the company and give them so-and-so amount of money to a private arrangement. But now if they go public, you can buy shares of Forbes and be an owner of it, kind of like what they do for McDonald's, Ford, and Tesla, and all those other companies. But again, that's just a short explanation. Now, continuing on. Why would a CEO and founder of Binance want to invest in a magazine that's over 100 years old? Because they're the new technology. Why can't they just do it on their own, give their own, let's say, media company? Well, here's the specifics about this deal. Apparently, Forbes, or the Forbes brand today, reaches more than 150 million people worldwide through its trusted journalism. Trusted. Anyway, and it does this through 45 licensed local editions covering 76 countries. And there you go. It says here, Forbes brand's extensions include real estate, education, and financial services license agreements. And through its digital platforms, Forbes is among the top 50 most visited websites on the internet. And that's what Binance is looking for. They're looking to get a company or invest in a company that already has a big foothold in the media space and that people know. I mean, I know about Forbes because I went to college and this was one of the main magazines that they would have in the library back when we had those things, right? When we had libraries and there was no real way to get the magazine online, at least not through a paywall, that's what I would read as Forbes, or we would quote Forbes. So Binance, knowing that they want to expand cryptocurrencies and blockchain as a whole, they're willing to make this investment so they can get their message out. So this is a good move. There's synergy here. When originally you would think, where's the synergy? It's being able to get in contact with all these people by spreading the word of cryptocurrency and blockchain, and with that, they can increase themselves. Continuing on. It says right here, Binance strategic investment will be through Binance assumption of subscription agreements representing the $200 million of commitments in the $400 million private investment in public equity, aka PIPE, that was announced alongside Forbes' intention to go public. With Binance assuming existing PIPE commitments, the overall size of the PIPE will remain at $400 million, and Binance investments will be according to substantially the same terms as existing PIPE investors, meaning that basically whatever were the rules for everybody else who's doing private equity, they're going to get the same benefits. That's it. Because usually they can have different rounds, meaning that the first people who are there normally get a more preferred share or stock. Basically, they're getting all the same amount of benefits as everybody else who put in private money. Says right here, as part of the deal, Binance Chief Communications Officer Patrick Hillman and Head of Binance Labs, Bill Chin, will join the Forbes Board of Directors. This is good. Well, yeah, it's good because if they're part of the Board of Directors, they can have a say in what gets put into Forbes magazine. So this does have a lot of their interest in it. So that's good stuff. And it says here, according to Forbes CEO Mike Federle, F-E-D-E-R-L-E. I don't know how to pronounce that. Anyway, the investment from Binance will help the firm to get experience, network, and resources of the world's leading crypto exchange and one of the world's most successful blockchain innovators, which that's true. I've used Binance.com. I've used the Binance blockchain or smart chain and PancakeSwap, which is one of the main swaps that they use to get crypto. So I can say that, honestly, Binance does a good job. So this is a good idea. It says here, Forbes is committed to demystifying the complexities and providing helpful information about blockchain technologies and all emerging digital assets, he noted. Binance founder and CEO Changpeng Zhao emphasized the importance of supporting media in the crypto industry as part of the company's commitment to boost consumer knowledge and adoption of cryptos. And it says here that Binance has apparently been succeeding on its mission to promote the knowledge of cryptos and Bitcoin so far. In April 2020, Binance acquired CoinMarketCap, which pretty big website, which is the most popular website, crypto website with 187 million visits as of August 2021. Apart from offering market capitalization charts, the website provides news, updates, and current event and current market leaders, meaning who are the top 10 in all cryptos, I guess. The firm subsequently launched its own crypto education portal known as CMC Alexandria in September 2020, which is basically just their version of an education blog. So, what's the good? The good is there is new technology and new money going into old money industries. I guess one would say Forbes could have been one of those websites or one of those industries, not industries, but companies that could have went the way of the dinosaur and been gone. But with Binance putting in their money and it going public, this will give cryptos an already established media sector or media channel to bring more attention to the crypto space. So the good is old industries are working with new industries to make new money. That is good. What's the bad? I can't really think of anything bad in this case. Maybe it's a monopolization of data, I guess. I think that's the only thing that can be technically bad, but I don't really see anything bad with this. But in my opinion, I think this is a really good sign that if you're looking to invest in cryptocurrencies at some point, that there will be a lot of support and a lot of adoption coming because there's going to be more educational instruments, more articles, more news that will educate the public in general on what cryptos are, which means it would solidify any of your current investments. Now, I'm not saying that you should just go buy a whole lot of cryptos right now and go buy every doggy coin there is, because, that's kind of stupid. And no, I'm not saying that you should go invest in Forbes, because it is going public. Maybe you could invest in Forbes. I mean, I personally am not going to. I'm probably just going to buy a Forbes subscription, which, why not? It's going for $50 right now. But in my opinion, this is just another article that just solidifies that cryptos is coming and that you got to get with the times, man, and maybe look into how that works and understand the technology a little bit better. If not, they're probably going to make it a little easier. And that's always a good thing, which is educating yourself on investing, how money works, and how the finance markets and where they're going. That's something that you should probably look into. And if anything, at least Zhengping Zhao, the founder of Binance, is trying to make that just a little bit easier. And if you don't have a Forbes subscription, maybe go get one. Thank you so much for watching me today. Hope I gave you something to think about. If there's anything that you'd like me to talk about on this channel when it comes to business, cryptos, self-improvement, or just some fun stuff, make sure to leave it in the comments so I can go ahead and provide you the content that you're looking for. Also, if you're looking to support me and what I do around here, make sure you check out the description on ways to do just that. And if nothing else, I'll see you in the next video.